All right, today, October 11th. A lot of interesting stuff happened today. Um, Let me start with the spider. All right, S&P had a false breakout yesterday. I remember seeing it go above the funnel, but it was really shallow. I think it was up at the most 0.39%. And remember looking at this and going, if it went up more, if it was over a 0.5% up, I would consider that a real breakout. But if not, it was just going to be a false breakout. And it closed above the funnel yesterday. And I remember thinking, if this if this continues tomorrow, it's going to be a break to the upside. But it was actually a break to the downside today. So I expect that we are going to see some further selling tomorrow. Um, I know futures are higher, but I definitely see us being down tomorrow or the next day. Within the next 2 days, we're gonna head down and test the 150-day moving average. Um, I think that we're gonna come down. We're probably gonna test the 207, and maybe even the 205, and very little chance of hitting the 198. So I see this sell off heading about here, but no more. And again, we need to see a confirmed breakout because right now we just have, really outside of the funnel, only about a 0.5% breakout. So we need to see more of that to confirm that this is a breakout to the downside. But if it is moving down, originally I would have said it was probably gonna take hit a rebound at this uptrend line since since February, but that was when it was back here, and since it grinded upward, I think it'll take out the support line and probably bounce off the 250-day moving average and head up. Another thing I wanted to show you, I know I shared this with a couple of people, is a S&P earnings cycle. All right, so back in 2006, we were earning, well, let's just go 2005. We were earning, way back here in 2005, we were earning $85 um, per S&P index. So like right now we're at, I think, like 21 30, 21 40, I forget right now. I'm looking at the SPY, which tracks it pretty good. But so for back in 2005, we were looking at having about 1,208 was making $85, and in 2006, you had an average of like 1,372 is making $97. Then we had the 2008 downturn, and 2010 we were making $85 again, and it's pretty much equivalent with where we were making $85 back in 2005, and in 2011 we were making $92, and it's pretty much equivalent to where we were back in 2006. Um, then in 2012 we were making $92 or $90 a share, which still, in 2011, 2012, we didn't really move anywhere, so that makes sense. 2013, we have a giant jump up. You can see over here, our earnings went up from 90 per index to 103 per index. So, a third, this is what, probably a 15% increase. So we saw at that time a 30% jump in the S&P. 2014 we barely gained 1%, but yet we saw a giant jump in the S&P. In 2015 we saw looks like about a 15% downturn in S&P, and we stayed the same. And in 2016 we went down another 1.5%, and we're higher than where we were. So we've been declining since 2014, yet we still continue to go up. So the earnings per index has gone down, but the index has still gone up. So we're at 87. In 2005, we were at 85. So at $85 earned per index, we're here and now at 87 we're here. So, at first you're like, well, fundamentals, that just doesn't make any sense. Um, this is a neat website right here. This is multiple.com. But let's take a look at something else now. We're going to go multiple.com, and you can play around with it. It's got a bunch of interesting stuff. But let's go to, where is it? Shiller PE ratio, or not Shiller PE ratio, but real PE ratio. Okay, so you see we bottomed out in the price to earnings. So it was the cheapest back in about 1919, 1980, 1950. This is when it's the cheapest. Since 1950, we've had almost this bubble created in price to earnings. I'm going to pull up a 50-year interest rate. Interest rates are highest in 1920 and 1980. Look where the bottoms are for price to earnings. About 1920, 1980. As interest rates are slipping, S&P valuations are going up. So this makes sense. So you can see that as interest rates continue to go down, the S&P is going to go up, whether it makes more money or not. It doesn't matter. So that's why I don't think right now, I don't see it going down anytime soon, because I really don't see interest rates going up at all. All right, so today I don't have a chart of the DXY, but DXY is going through the roof. It's at 97. 97, what is it, 50, I think, last I looked at it. And when I was looking at it last week, I thought it was going to top out at about 96.30. So I remember looking at a chart, and it's significantly overbought. I think it's over 70, but it's still going strong. So the dollar has been powerful. It's been knocking everything else down. Let's pull up some currencies. Let's look at the Australian currency. Took a beating. Let's look at the euro. Euro actually did something pretty interesting today. It actually broke out of its the funnel it's been in. This isn't really, I wouldn't consider this a confirmed breakout because it's not a large breakout. If it was down here or up here, then it would be a confirmed breakout. If it was down in here, that's a breakout. But this could just be, testing the side. These aren't exact lines. Here we have a little bit of testing over too, but some significant drop in the euro due to the dollar strength. And the dollar is really strengthening because everyone's fleeing the pound, and they're fleeing the euro too, because it's a look for safety. The pound, no one knows if it's continue to drop. I don't think it will continue to drop at the rate it has. But you're seeing a flight from safety from these countries to the dollar, and especially because our bank yield right now, I think, is 1.77. It was 1.56 about a month ago. So our rates on our 10 years have been going up compared to like Germany, where you're negative. So there's been a flight to the dollar, which has wreaked havoc among a lot of the assets we're going to look at. And we'll pull up the Australian. This tracks the Australian market, down 2%. Let's look at Brazil. Brazil down almost 1%. So everything took a beating today relative to the dollar. All right, let's look at gold. Oh, that's Rand gold. Hold on. Gold. All right, so we're looking at gold. Gold didn't really do much today. It was down about 0.5%. It's grinding sideways like I thought it was. I still think it'll dip down between these two purple lines, and that's sort of where it's going to find its bottom, and it's going to grind sideways until it does that, and then we'll see a pop. It was hit by the dollar. It's been getting hit by the dollar. But it's also being, it's being hit by shorts. because most markets are controlled, by large amounts of money being either sold or bought into the market. So what's happening here is the shorts have been knocking down gold, and they've really been knocking it down because they were caught really offsides with the Brexit vote that happened right about here. Um, and you can see that they were knocking it down here, and no one was expecting, um, the British to leave. Everyone was expecting them to stay. Even the giant money movers like the banks and giant hedge funds, because usually they know what's going to happen before stuff happens. Like the S&P, they know which way the S&P is going. They're creating the sell-off we're seeing today. They create the fact that the market is going higher. They know what's going on before it goes on, and they control it. And they couldn't control Brexit, even though they put lots of media ads out there trying to get the British to stay in, and they did all sorts of stuff. And I even think they killed that young politician, Jo Cox. That girl. It was some white guy. Shot her and said, like, "Yay, Britain." No immigrants. I mean, come on, that happens. Give me a break. That was definitely a setup. But they tried everything to keep the British to stay, and the British didn't stay, and it shot gold up. And what you can't see is this is during hours trading. It was actually way up here in pre-hour trading. So all these shorts, these big money things, and these banks, they got caught completely offside, and they're not going to take a big loss. So they've been hitting it with shorts all the way down, and they hit it here. I know back here they dropped, I think, $1.5 billion worth of shorts on it, and here they dropped 100 tons of gold worth of shorts on it. So they've been trying to drive it down, and they're going to get it below this mark right here before we see a rebound, because they're not going to want to take losses on those positions. And you would be like, well, why can't they just keep shorting it forever? Well, it's not like a stock. A stock they could short forever. They could drive it into the ground, but gold is different because gold has value outside of the stock market. Like if I was to take a printout that said I owned 10 S&P shares, I couldn't just go down and trade someone that for that piece of paper, because that piece of paper is worthless to them. Those S&P shares are in my name. I have to sell them. I have to go get the cash. But I can take a gold coin or a bar of gold. I can go anywhere in the world, the most backwards country in Africa, wherever, and I could trade that gold bar, that gold coin for something, because it has intrinsic wealth. It's been recognized for thousands of years as valuable. So that's why they can't keep knocking gold down forever where they could with a stock, because gold is always going to have demand outside the paper markets. If something only has value in the paper markets, you can completely manipulate it. But if it has value outside the paper markets, like if I can go to any country in the world and present them with a gold bar and someone would be willing to give me something for it, you can't just knock it down. And then, mix that with jewelry demand and traditional demand in all sorts of countries. You are never going to be able to knock this thing to the floor, because people would just buy it all up. If they knock gold down to $500 an ounce, there would be no gold, liquid gold available. There would be nothing, because it would all be, bought up. So, but at this point, they can knock it down pretty good, and I think that's what we're seeing here. We're seeing we haven't touched the 250-day moving average. Like I said, usually we'll come down and we'll break that slightly, and then we're going to start to see a move up. Another reason I think that they are gonna gold is continue to go down, and I'll show you later, is gold stocks and the S&P have all been moving really in the same direction for the last year. And I think that what's happening is that a lot of the gold stocks, the GLD, are bought up in index funds and ETFs, so that when people mass sell the S&P, it's also driving down these metals and these stocks. All right, let's see what we got next. So I said in one of the previous videos, I don't remember exactly what I said, but I said, I thought it would hit down, it would sort of grind sideways, but it was going to head into this area. I don't remember. I'm pretty sure that's what I said. You can fact check me if you want. Go check out my videos, or I guess you could go on like HillaryClinton.com or something like that. Something that has lots of facts or something like that. But like I said, definitely going to break this 250-day moving average. I can see it. Looks like we had a minor rebound, and we're going to finish this sell-off, and then that's when we're going to go higher. And I think right when we get into here, we're going to see a dead cat up to about here. Just like when I showed you on all those other things where when you have this trend line and you break it, we will then retest it for the bottom and fall. And that's where I'm probably going to liquidate the positions I'm buying up now, because even though it could go higher, I think that it'll hit this from the bottom and it'll bounce down a little bit, and then it's going to hit it and break through. So that's where I'll probably play it as. I'll be buying in here. I've already bought some. I'll wait for it to go retest in the dead cat. I'll sell it. It'll probably come back down, and then when it goes and finally breaks this 2011 downtrend, then I'll enter it here. Or if it hits at dead cats and it heads down, then I've already liquidated. I've made a good amount of my money, and I'm still protected. So let's pull up JNUG. All right, let's see what's going on here. All right, so it looks like I'm gonna get my opportunity to pick it up cheaper right now. I've been up 10%. I've been even up 10%, even. But right now, I'm pretty much breaking it. I think I'm a couple cents under. I have one position that I opened at 9. These are equal weighted positions, 996. Another one I opened at 970 a couple days ago. I'm really hoping that it does get knocked down and this does get taken down with the S&P, because once it rebounds, if I can get something around 810, it's probably going to rebound to about 1650. That'll be about 100% increase. And even if it rebounds to 12 from 810, it's still a 50% increase. And my positions I bought in the 9s are still up about 30, percent. So it's definitely gonna rebound. It's just a matter of when, and I don't see the selling being strong to the downside. All right, let's pull up the GDXJ. All right, we're at 37.31. I think this thing is going to be dragged down in the next couple days. It's up in after hours, but I don't know if that'll stick through the night. And I'm definitely thinking in the next couple days we're gonna test the 36 level. I know I told someone about a month ago roughly that I thought it was heading to 36. I think the lowest it could probably hit is in the 35.76, and I can't see it going much lower than that. So it's gonna move down into here, and then we're gonna see a jump in that. Like I said, gold stocks. The thing about gold stocks is that sometimes they act like gold and sometimes they act like a stock. So let's pull up. Well, actually, let's overlay these. That'll be easier. That if the stock market is getting sold off, the gold stocks are going to go with it. We saw this in 2008. We saw this in when did we see it? Recently. Let's go to the 3 bull. If they're selling the S&P, if they're selling ETFs, like if I sell the SPY, these stocks are going to take a hit because these stocks are in the SPY. Hold on, what's going on here? Let's see, overlays. Why is this? There we go. All right. So when the SPY gets sold, these stocks get sold. Notice, this is the February. Got hit. This had no reason to go down, but it got hit here. Here, this didn't really touch it. Brexit didn't touch it, obviously, because gold went through the roof. So when gold went through the roof, it sort of null and voided this. But look, we got hit here, brought it down. Here, bringing it down. When this gets sold in mass, it'll drag this down. So you just got to be careful about that. If we're going into a deep sell-off, which I don't think so, you're going to see the gold stocks take a hit with it because they're tied to the S&P because, or not just the S&P. There's only one, I think, in the S&P. But when the ETFs in general, large caps, small caps, like if I sell the Russell, if I sell the SHCX, if I sell these big things, if the whole New York Stock Exchange as a whole or the Canadian Stock Exchange as a whole gets sold off, these stocks are going with them. So that's why I also think we've got some little bit more down room. But I think we're at our end. Like I said, this isn't going to be very significant. And I think within the next week and a half, we're going to see a pop in the S&P and we're going to see a significant pop in the gold stocks because they are oversold. So yeah, they are not in the SPY. There's only one in the SPY. Most of them though are either the Canadian Stock Exchange or the New York Stock Exchange. So that's one thing just to be aware of. That if we do see a 2008 like correction, which we're not gonna, I can almost guarantee it, not before the election. They're not gonna take that chance. You're gonna see these stocks take a brutal beating. But right now, I think we're pretty safe. And like I said, I think the shorts are about done hitting gold, and I think we're going to see a rebound in this market. So that's just an update. Keep your eyes open.